Hello, everybody, and welcome. Here we've got problem 10.7. So on June 1st, Laserwords contracted with Black Construction to have a new building constructed for $4 million on land they already own. The payments made by Laserwords to Black are as follows. Construction was completed and the building was ready for occupancy on May 27th, 2021. Laserwords had no new borrowings directly associated with the new building, but had the following debt outstanding. So the new building qualifies for interest capitalization, and it is material. And the last thing we also want to look at right over here is their fiscal year is ending May 31st. So it's not a December 31st fiscal year end. Okay, so we can approach this problem a couple different ways. However, the first thing we can do is to figure out what is going to be our, well, do the weighted average accumulated expenditures. So the first one here is July 30th, 2020. The amount was 900,000. And what I'm asking here is, what is the months outstanding for the year? And what this is going to be July 30th through May 31st. Or if we count it out on our fingers, we have August, September, October, November, December, January, February, March, April, May. So this is going to be a total of 10 months. So my weighted average construction expenditure is going to be 750,000 for that particular item. My next one is 131.21. My expenditure is 1.5 million. The months outstanding is going to be January 31st or January 30th to May 31st. So this is really, since this is the end of the month, this is really going to be February, March, April, May. And I'm kind of like, if I look at the dates over here, this is not really 5/31, it's really 5/27, because that's when they went through and actually finished it. But as far as the dates go, I'm cool with, at least for my class, it's really over here. This is really going to be 4 months, or February, March, April, and May. And this is for 1.5 million times 4/12. So this is a total of 500,000. So 5/30/21, 1.6 million. But since the building was already completed at this time, we're not going to include that in the weighted average construction expenditures. Okay, so my weighted average accumulated expenditures on the new building is simply going to be 1.2 million. Okay, so the next thing I need to do is to figure out the avoidable interest. To figure out the avoidable interest, normally what I would do is I'd say, okay, do we have any construction debt? The answer is no. So my weighted average So I don't have any specific construction debt, but what I do need to do is to look at my other debt. So I have two loans. This is the 5-year note, and this is the 10-year bond. Okay, so this is at 2 million, and this is at 3 million. My interest rate here is 10%. My interest rate here is 12%. So when I multiply these things out, and what I need to do is I need to come up, when I'm computing avoidable interest, I'm going to take this of 1.25 million. I'm going to multiply this by my interest rate. Typically, for most of these problems, what we would do is we would go through and we would figure out, was there construction specific debt? And that's what we would do. But since there is none, we have to look at the other debt. So this is kind of similar to an exercise that I went through and did a little bit earlier. But if I go through and I add these two here, and I add these two here, this is my total cash paid for interest. So when I take the cash paid for interest divided by the total debt outstanding of 5 million. When I divide these two, I'm going to be coming up with a rate that should be between 10% and 12%. But it's going to lean a little bit more towards 12 because this is the greater dollar amount. So right over here, I get a total of 11.2%. So my interest rate that I'm going to be using is 11.2. So my avoidable interest is going to be $140,000. So my avoidable interest is $140,000. So that is going to be the amount of interest that we're going to be capitalizing. So the avoidable interest, $140,000, and identify the items relating to interest costs that must be disclosed in the financial statements. So my cash paid for interest is $560. My capitalized interest as a result of the construction is $140,000. So my interest expense is going to be the difference, or $420,000, or the favorite number of Mr. Elon Musk. So as we look here, this is the breakdown. Okay. So that is problem 10-7. And again, if you want to kind of see a little bit more in terms of this kind of how I was coming up with like these different parts, you can also take a look, and I believe I want to say it's exercise 10-7, because this also has the weighted average. This also is dealing with some other debt that was outstanding. So thank you for joining me here today for problem 10-7, and I look forward to seeing you on the next video. Have a great one.